Last week, a tech billionaire successfully transitioned his off-grid utopian island from a primitive barter system to a fully digital banking economy. But by introducing commercial banks, they made a fatal miscalculation. Through fractional reserve lending, the banks accidentally created too much money out of thin air. Now, the island is facing total economic collapse. A standard cup of coffee costs $100. Rent has quadrupled. This is the invisible destroyer of wealth, inflation. And to stop it, the island's chief financial officer must take absolute control over the money supply. Welcome back to the Banker's Desk. Today, we are opening the master ledger to explain the most powerful force in global economics: monetary policy. Historically, when money was tied to gold, the only way the money supply could grow was by mining more of it. If a gold rush flooded the market, gold became less rare, its value fell, and prices surged. Conversely, if mining couldn't keep up with a growing economy, money became scarce, causing deflation. But modern economies, just like our billionaire's island, use fiat money. It isn't tied to gold. The supply is entirely controlled by human decisions. When the island's commercial banks lent out too much digital cash, they diluted the purchasing power of every single worker. Too much money was chasing too few goods. If the CFO doesn't intervene, this will escalate into hyperinflation, a total monetary collapse where the currency becomes completely worthless. Before she can fix the problem, the CFO needs to measure exactly how much money is flowing through the island's system. She categorizes the money based on its liquidity, how easily and quickly it can be spent. Think of it as a supply chain of wealth. First is M0, the base money. This is the physical currency and the strict reserves held at the central bank. It is the raw material of the economy. Next is M1. This includes all the physical cash in people's pockets, plus their demand deposits, checking accounts they can access instantly via debit cards. This is the most liquid tier. Then we move to M2. This includes everything in M1, but adds savings accounts and small time deposits. You can get this money, but it takes a little more effort. Finally, M3. This includes M2 plus large institutional time deposits and relatively illiquid financial instruments. This money is frozen in the vault for the long term. By tracking these aggregates, the CFO realizes the M1 supply has grown dangerously fast. The pipeline is overflowing. She has to tighten the valve. The central bank. To enforce her will, the CFO establishes the island's central authority, a unified central bank, to act as the ultimate regulator. Her mission is to execute monetary policy. The textbook defines this as managing the money supply to achieve stable prices, moderate interest rates, and maximum employment. She has an arsenal of tools to pull money out of the economy. First, she raises the reserve requirements. She legally forces the commercial banks to lock more of their deposits in the vault, immediately reducing the amount of money they are allowed to lend out to the public. Second, she executes open market operations. The central bank begins selling high-yield government bonds to the public. Citizens happily use their excess M1 cash to buy these bonds, effectively removing that cash from active circulation and locking it away in the central bank's vault. Finally, she aggressively raises the interest rates. This is the cost of borrowing money. By making loans highly expensive, businesses stop borrowing to expand. Consumers stop borrowing to buy luxury goods. Spending drops. The CFO's aggressive monetary policy works. The money supply shrinks, the inflation cools down. The price of a coffee returns to normal. The island is saved from the brink of collapse, proving that wealth isn't just about how much money exists, but how effectively it is controlled from the top. Understanding monetary policy separates the financial experts from the amateurs. It is the invisible current driving global markets. If you found value in this breakdown, hit subscribe. Let me know in the comments how you would have handled the island's crisis. And I'll see you at the desk next week.